Hi there, welcome back to PwC's monthly economic barometer. I'm Jonathan Westhead. We were hit by a slightly cold blow this month when our barometer dropped 9 points after its peak in February, settling at plus 17 for March. In Luxembourg, trust is falling despite the rather positive macroeconomic indicators. The global stock market's near correction we saw in February most likely played a large role in this decline. I'm sure our market expert, Dariush Yazdani, will have something interesting to say on this topic. Dariush, thanks for joining. Although we've seen markets rebound, are we seeing talk about this correction being a precursor to a larger one happening in the near future?
Jonathan, that's an interesting question. Let's take a step back and look at where we stand since Trump's inauguration. So if you look at it, since 20th of January 2017, Trump's inauguration, till 12 months after, the Dow Jones rallied 31%. So the correction that we are expecting, or you have seen volatility increase, is normal. Investors are nervous, so that we see a correction that is around 10% or 15% from the highs would be healthy. Now, nobody can say when or if this correction will happen. However, the indications, if you look at number of investment banks indicating that there will be a healthy correction coming up this year, is to be foreseen.
Great. Well, thanks, Dariush. Let's hope investors are prepared. Turning back to Luxembourg, Statec forecasts an average growth of 4% from 2018 to 2020, well above the Eurozone, which should remain at just over 2% in this period. Luxembourg's growth would then remain at 3% until 2022. This is despite monetary tightening and rising rates in the medium term. Overall, this growth is expected to reduce unemployment to 5% and be accompanied by a relatively low inflation rate of around 1.4% in 2018 and 1.8% in 2019. Europe was not immune to the near correction either. The Euro stock slumped 9% in 10 days in the beginning of February. Despite the rise in world trade, the strong euro effect is starting to be felt on the European exports. The rise in new orders slowed in February, which translated into a slight drop in markets' manufacturing PMI at 58.6 in March, down from 59.6 in January. This slight slowdown in orders could continue in the coming months, but it's unlikely to immediately weigh on production as order books are full and production arrears continue to increase. Like the IMF last month, the European Commission has revised its growth forecasts upwards for the European area and now expects a 2.3% growth for 2018, up from 2.1%. Despite the strong euro, the ECB's durably accommodative policy, with no rate hike expected before 2019, and low inflation will continue to favor exports, which is supported by the recovery in world trade. That's all for this month. Thanks for watching. See you soon.